Hey deep divers, welcome back to the channel. If you're ready to decode the world of economic indicators with us, hit that like button and subscribe. We're going to be talking about, those signals that help us understand where the economy is headed.
And maybe even where our wallets are going.
Right.
Yeah, it's like learning a secret language, isn't it? These indicators can tell us so much more than just, those headlines you always see about record highs or plummeting markets.
Okay, I'm ready to crack the code, but I have to admit, when I hear economic indicators,
Mm-hmm.
honestly, I just think boring spreadsheets.
Yeah.
Convince me, why should I care about this stuff?
Because they're about more than just numbers on a page. They're about understanding the forces that shape our daily lives, from like the price of your morning coffee
Oh yeah.
to the job market to, whether or not you should finally book that vacation.
All right, you got my attention. But the source material we're diving into mentions indicators I've never even heard of.
Uh-huh.
We're not just talking about unemployment rate or GDP here, right?
Definitely not. We'll be exploring those familiar benchmarks, but also some intriguing indicators that you might not expect, like the men's underwear index.
Whoa, okay, now that one I have to hear more about.
Mm.
But first, let's break down how these indicators actually work. It feels like the economy is this giant interconnected machine,
Yeah.
but I don't always see how all the gears are turning.
That's a great way to put it, and that's what is so fascinating about economic indicators. They help us see those connections. For example, think about the house prices. New and existing houses indicator.
Okay, so that one seems pretty straightforward, right?
Yep.
Tells us how much homes are costing.
Right, but think about the ripple effects. Rising house prices can directly impact the housing affordability index,
Okay.
making it tougher for people to, buy homes.
Yeah.
And that can then influence lending practices, potentially even leading to, shifts in mortgage delinquency and foreclosure rates.
So it's like a domino effect. One indicator can set off a chain reaction across others.
Precisely. And that's just one example. Think about the balance of trade, which tells us how much a country is exporting versus importing. Might seem like a kind of a wonky government statistic, but it can actually impact something very real, the value of the dollar.
Okay, wait, hold on. How does selling stuff overseas affect how much my dollar's worth, like, here at home?
It all boils down to supply and demand. When a country has a trade deficit, meaning it's importing more than it's exporting,
Okay.
it can lead to an increased supply of its own currency in the foreign exchange market, and that can weaken the currency's value.
So if the U.S. dollar weakens because of a trade deficit, does that mean, like, my imported cheese gets more expensive?
It certainly could. A weaker dollar can make imported goods pricier, and that can have a real impact on, your grocery bill, your travel plans, even the cost of electronics.
Okay. I'm starting to see how these seemingly distant economic forces can actually hit pretty close to home. But let's talk about the indicators that really hit our wallets, like the ones that directly track our personal finances.
One key indicator to watch is personal income and saving. It's not just about wages and salaries.
Yeah.
It also includes things like investment income and government benefits, giving us a more, holistic view of household financial health.
Right. It's about the total money coming in. And the saving part is interesting too, especially these days. It's not just about being frugal. It's a reflection of how much wiggle room people feel like they have financially.
Absolutely. And then we have indicators that reveal the disparities that exist within the economy, like the distribution of income and distribution of wealth.
Right.
These can highlight important issues related to poverty and economic mobility.
So by looking at these indicators, we can get a sense of not just how the economy is performing overall, but also how that performance is actually distributed, which can be a really different story sometimes.
Exactly. And it's important to remember that these indicators are about more than just the present moment. The way the poverty threshold is determined and adjusted over time, for instance, gives us valuable insight into the, long-term evolution of poverty in the country.
Okay, this is already making me rethink my whole economic indicator allergy.
Mm-hmm.
But so far we focused on like the hard numbers. What about gauging how people are feeling about the economy? Isn't that a factor too?
Absolutely. And that's where indicators like the Consumer Confidence Index come in. This literally measures how optimistic or pessimistic people are about their financial futures and the overall economy.
So it's like taking the pulse of consumer sentiment. And if people are feeling good, they're more likely to stand right.
Exactly. And then there's the Help Wanted Advertising Index,
Uh-huh.
which can be a fascinating indicator of employer confidence.
Okay.
It's not just about the number of open positions. It's about how actively businesses are seeking to fill them,
Okay.
which hints at their outlook on the future.
So if companies are plastering help wanted signs everywhere, That could be a good sign, right?
Hmm.
They must be expecting growth and gearing up to hire.
That's one way to interpret it.
Okay.
On the other hand, a decline in help-wanted ads might indicate a more cautious approach, potentially signaling an economic slowdown.
All right, things are getting really interesting now. It's like we're piecing together a puzzle using indicators like job gains and losses, job openings and labor turnover, and even bank loans, commercial and industrial, to get a sense of the bigger picture. But I cannot wait to hear about those unconventional indicators, especially the men's underwear index.
That's where we'll pick up in part 2 of this economic deep dive.
Okay.
We'll explore those offbeat indicators and what they can reveal about the hidden rhythms of the economy.
I'm hooked. We'll be back soon. Deep divers, don't forget to like and subscribe so you don't miss it.
Welcome back, deep divers. It's great to continue our exploration of economic indicators. We're about to uncover some truly fascinating insights.
I am ready for more. In part 1, we were talking about how the balance of trade
Yeah.
can actually influence the value of the dollar. It still feels a bit like economic voodoo to me. Can we break that down a little bit further?
Absolutely. Imagine the balance of trade as a giant scale. On one side, you have a country's exports, the goods and services that's selling to other countries, and on the other side are its imports, the things that it's buying from the rest of the world.
Okay, I can picture that. So when the scale tips towards exports, the country has a trade surplus.
Exactly. It's bringing in more money from selling its goods and services than it's spending on imports. But when the scale tips the other way and imports outweigh exports, that creates a trade deficit.
And that's often the case with the U.S., right? We seem to import a lot of stuff.
That's right. Think about all the electronics, clothing, cars, even food that comes from overseas. All of those imports contribute to a trade deficit.
Okay, so how does that connect to the value of the dollar?
Well, when a country has a trade deficit, it means it needs more foreign currency to pay for all those imports. So it's essentially selling off its own currency to buy those foreign currencies like euros or yen.
So it's like flooding the market with U.S. dollars.
In a way, yes. And when there's a larger supply of something, its value tends to go down.
Ah, I see. So a trade deficit can weaken the dollar. But what does that actually mean for me? Does a weaker dollar mean I should stock up on imported cheese while it's cheap?
Well, a weaker dollar can make imported goods more expensive because it takes more dollars to buy the same amount of foreign currency so that cheese could actually get pricier. But it can also make U.S. exports more competitive as they become cheaper for buyers in other countries.
Okay, so there are two sides to this coin. A weaker dollar could hurt my wallet at the grocery store, but it might benefit American businesses that export goods.
Precisely. It's a complex interplay of factors, and that's why it's so important to look at a range of economic indicators to get the complete picture.
Speaking of things that hit close to home, let's dive into those indicators that directly affect our wallets. We briefly discussed personal income and saving in part 1. Could we unpack that a bit more?
Of course. Remember, personal income isn't just about wages and salaries. It includes all sorts of income sources like investments, government benefits, even that side hustle you might have going.
Right, so it's the total amount of money flowing into households, and the saving part tells us how much of that income people are setting aside rather than spending.
Exactly. And saving rates can be influenced by all sorts of things, from interest rates to how confident people feel about the economy.
So if people are worried about a potential recession, they might tighten their belts and save more.
That's a common response. Conversely, when people are feeling optimistic and secure, they're more likely to spend freely and saving rates might dip.
Makes sense. It's like taking the temperature of consumer confidence through their bank statements. But what about those fascinating unconventional indicators we touched on earlier? I'm really curious about that men's underwear index.
Ah, yes, a classic. It might sound strange, but there's actually a theory that men's underwear sales are a surprisingly good indicator of economic health.
Okay, I have to hear this. How do boxers and briefs predict economic downturns?
The idea is that men's underwear is a necessity, but it's not something that men typically splurge on.
Okay.
It's a relatively stable purchase.
So guys aren't exactly running out to buy new underwear when times are tough.
Exactly. So when sales of men's underwear start to decline, it can signal that consumers are pulling back on spending, even on essentials. And this can be an early warning sign of a broader economic slowdown.
It's like the canary in the coal mine of the economy, but with boxer shorts.
You could say that. Interestingly, sales of men's underwear did dip significantly in 2007, just before the Great Recession hit.
Whoa, that's actually pretty insightful. Are there any other unconventional indicators that are, shall we say, a bit more glamorous?
Well, there's the lipstick index. It suggests that lipstick sales tend to increase during economic recessions.
Wait, really? You'd think people would cut back on makeup when money is tight.
That's the logical assumption. But the theory behind the lipstick index is that lipstick is a relatively affordable luxury. It's a small way to treat yourself and boost your mood even when you're facing financial constraints.
So it's like a little pick-me-up during tough times. Makes sense. Are there any other indicators that tap into that psychology of spending?
There's the dry cleaning index, which proposes that when people feel secure in their jobs, they're more likely to spend on dry cleaning.
So a drop in dry cleaning sales could be a sign of rising unemployment or job insecurity.
Interesting.
That's the theory. And then there's the skyscraper index, which links the construction of skyscrapers to economic booms and busts.
Wait, skyscrapers can predict the economy. That sounds a bit far-fetched.
It's based on the idea that skyscraper projects are often launched during times of economic optimism and easy credit. But these massive construction projects take years to complete. By the time a new skyscraper graces the skyline, the economic cycle might have shifted, and a recession could be on the horizon.
So the completion of a skyscraper could actually coincide with an economic downturn. I never would have thought of that.
It's an interesting correlation, though, not a foolproof predictor.
Of course. These unconventional indicators are fascinating, but they're probably best taken with a grain of salt.
Absolutely. They're not always reliable, but they offer a glimpse into the psychology of the markets and can sometimes reveal surprising connections. This is so cool. It's like we're learning to read the hidden language of the economy, from boxer briefs to lipstick. I can't wait to hear what other indicators we'll uncover in part 3.
Stay tuned, deep divers. We'll be back soon with more economic insights and intriguing indicators.
Welcome back, deep divers. I'm still thinking about those unconventional indicators from part 2. Who knew that men's underwear and lipstick could tell us so much about the economy?
It really is remarkable, but those are just a couple pieces of the puzzle to really understand where the economy's headed. We need to look at a broader range of indicators,
Yeah.
including those that help us track trends over time.
That's where those leading coincident indexes come in, right?
Exactly.
They sound like a powerful tool for forecasting economic activity.
They're like economic dashboards combining multiple indicators to give us a clearer view of where the economy has been, where it is now, and where it might be going.
So the leading indicators are like the scouts providing those early warnings of potential shifts in the economy.
Exactly. They tend to change direction before a broader economic shift, like a recession or an expansion.
Okay.
Some classic examples include building permits, stock market performance, and consumer expectations.
Okay, so if building permits are up, it could suggest that construction activity is about to boom, which is, a good sign for the economy.
That's one way to interpret it. It suggests that businesses are feeling confident enough to invest in new projects, and then we have the coincident indicators, which move in sync with the current state of the economy.
So they're telling us what's happening in the economy right now.
Precisely.
Right.
Examples include employment levels, industrial production, and personal income. If those indicators are trending upward, it's a good sign that the economy is in a healthy state.
Makes sense. And then we have the lagging indicators, which bring up the rear.
That's right. They tend to change direction after a shift in the overall economy has already occurred. Think of them as confirming the trend. Lagging indicators include things like unemployment duration, the prime rate, and the consumer price index for services.
Wait, the prime rate. Can you remind me what that is again?
Of course, it's essentially the interest rate that banks charge their most creditworthy customers. It has a ripple effect on all sorts of loans, from mortgages to car loans to credit cards.
Right, so it's a key benchmark for borrowing costs across the economy.
Yeah.
I'm starting to see how tracking these different types of indicators, leading, coincident, and lagging, can give policymakers and businesses a real advantage.
Absolutely. If the leading indicators are suggesting a potential slowdown, policymakers might consider implementing measures to stimulate the economy, while businesses might take a more cautious approach to investment and hiring.
Okay, let's switch gears for a moment and revisit an indicator we talked about earlier, bank loans, commercial and industrial. Why is this one so important to track?
It's a vital sign of business activity and investment. When companies are feeling confident about the future, they're more likely to take out loans to expand operations, buy new equipment, or hire more workers.
So a surge in commercial and industrial loans could be a sign of a healthy economy, with businesses feeling really bullish about growth.
Exactly. It suggests that businesses are willing to take on more debt because they believe that the returns will justify the risk. Conversely, a decline in these loans might signal a more cautious outlook, potentially reflecting concerns about economic growth or access to credit.
This reminds me of those indicators we discussed that track business sentiment, like the Help Wanted Advertising Index. Are there any other indicators that can give us a glimpse into how businesses are feeling?
There are quite a few, actually. Surveys of business confidence, for instance, ask executives directly about their expectations for the future. We can also look at things like inventory levels, which can tell us whether businesses are stocking up in anticipation of increased demand or cutting back due to uncertainty.
It's amazing how all these different indicators weave together to tell a story about the economy, almost like a real-time economic novel unfolding before our eyes.
That's a great way to put it. By analyzing these indicators, we can gain a much deeper understanding of the complex dynamics at play, from consumer confidence to business investment to government policy. And who knows, we might even be able to predict the next economic twist or turn.
Okay, before we wrap up, I have to ask about one more unconventional indicator that really piqued my interest. The guns to caviar indicator. That sounds pretty dramatic.
It is a rather unique indicator, that's for sure. It compares global spending on fighter jets, representing military spending, to spending on business jets, which often symbolizes luxury and high-end wealth creation.
So a surge in fighter jet spending might suggest like heightened global anxieties and potential instability.
That's the idea. It could indicate that governments are prioritizing military preparedness over other investments, potentially signaling concerns about geopolitical risks.
I see, on the other hand, if business jet sales are soaring, it might suggest a more optimistic and prosperous global outlook.
Exactly. It suggests that businesses and wealthy individuals are feeling confident enough to invest in these high-end luxury items.
This has been an incredible journey through the world of economic indicators. I feel like I've gained a whole new set of tools for understanding how the economy works, from traditional measures like GDP to those quirky offbeat indicators that reveal the hidden psychology of the markets.
It's been a pleasure diving deep with you. Remember, Deep Diver's economic indicators are more than just numbers. They're clues that help us decipher the forces shaping our world. So stay curious, keep exploring, and never stop questioning the data.
That's great advice, and a huge thank you to all of you for joining us on this economic adventure. Don't forget to subscribe to the channel for more fascinating deep dives, and hit that like button if you enjoyed this episode. Until next time, deep divers keep those economic gears turning.